Joining me right now on the line, I'm so pleased to welcome back to the show Lance Roberts. You can find Lance at realinvestmentadvice.com. Lance, thanks for finding the time. I know, of course, it's Canada Day weekend here and July 4th weekend in the United States, so appreciate you finding time for us.
Well, first of all, just let me correct you really quick. We don't celebrate 4th of July. We celebrate Independence Day.
Yes.
This is a very important day that people forget. We get wrapped up in the date. We forget the importance of 56 men signing a Declaration of Independence that established the very basis of the American greatness that became the American economy.
And how apropos that taxation without representation played such a major part.
Absolutely. And isn't it interesting that, after, all the years that Britain was an empire of the world, that they joined the EU and have now separated themselves back out to reestablish their sovereignty. And as you were just correctly stating, everybody threatened that if they did that, the world was going to collapse. Well, let's all remember that, again, Britain was a sovereign empire for hundreds and hundreds of years. I'm sure that they will be able to survive just fine on their own once again.
Well, another reminder, when we looked at the markets, we got the predictable market collapse, really, on the Friday of the vote. But I said, again, the establishment got away with something there because they told people, if the Leave side wins, all hell is going to break loose, nonstop. So how could we be surprised when it did? I mean, they set that up. It'd be very different if the vote, the establishment had said, look, I think you should stay in the EU, but if we vote to leave, it won't be that big a deal. I tell you, the markets wouldn't have reacted the same way.
Well, it's interesting. Actually, we have to go back in time just a little bit. The week before the vote was going to occur, the markets were actually selling off. And the markets were kind of positioning themselves for a potential that, there could be a leave here. So they took some of the premium out of the market. Then that Monday, leading up to the vote on Thursday, the markets rallied right up into the vote. We actually broke above 2,100 on the S&P 500 because everybody was assured now that Britain would remain in the EU. Of course, that set up the surprise when the referendum showed a leave win that sent the markets in turmoil for 2 days. We lost 100 points. We got to keep this in perspective, Mike. We lost a total of 100 points on the S&P. That was the disaster that was predicted.
And now we've had the recovery, full recovery on many, many markets and stock markets. What's the message there? Was it that we just overreacted, or maybe is it broader? We should never react like that to an event like that. I had said up to the time that be careful. This is a single event, and you need more news to keep fueling the direction of it. So we got that I think most people who are familiar with the markets can't be surprised that you sort of got 1-2 days and then a recovery. But does that mean we should have ignored Brexit altogether?
No, not at all. First of all, there's some long-term ramifications that are going to continue to plague the markets here as we go forward. The foremost of which is that when other countries in the EU that are being absorbed into this kind of the sovereignty, the sovereign monetary type, let's bail out Greece at the expense of our own country, as other countries start to look at Britain and see them begin to succeed, when they begin to see the impact of reduced immigration into their country, when they begin to see the impact of the ability to control economic outcomes and make policy that is best for your country rather than that which is directed by the social kind of agenda of the EU, other countries are going to want a referendum to leave as well. I think, this is my prediction, that within 5 years the EU will no longer exist in its current form and nature because of the disintegration of the EU was just set into motion. So longer term, I do think this is a much bigger thing that we need to be watching. On Tuesday of last week, I wrote an article said central banks to the rescue, and we heard minor rumblings, and this is what began the rally back from 2000 back to 2100. The ECB, the Bank of England, even the Federal Reserve were dropping comments about further monetary easing, further interest rate actions, et cetera. On Thursday, we saw those come to fruition with Bank of England talking about lowering their interest rate, the ECB coming out talking about more QE. So this rally was simply, again, as expected. Every time we have a dip in the market, central banks come to the rescue. The problem with this is that this is training investors to not pay attention to risk. there is going to be a major reversion at some point. Central bank interventions, monetary policy does not cure the debt problem or the economic problems that currently are plaguing the global economy, and particularly that in the U.S., as we're seeing more and more disintegration of economic growth there. There will be a decoupling at some point, and the problem is investors are being trained to believe that central banks will always come to the rescue. There will be a point where that does not occur, and the damage will be done.
A couple things. One is you're more optimistic on the EU than I am.
You're not giving him 5 years?
You gave him 5. Yeah, I'm not giving him that long. Yeah, you may not have caught, because it was just yesterday that the called the Freedom Party, they're an anti-EU party, they had pressed their equivalent of the Supreme Court and saying there were way too many irregularities in the election last month, and they were granted, they voided the election. And now it's going to be redone in Austria, and you're just seeing it everywhere. The 5-star movement in Italy, et cetera. Yeah, I think it's even sooner, and the financial pressures are key. But I love your point about this, is that right now there is this sort of assumption, especially on the part of professionals, to say no matter what the problem, the central banks will solve it. I agree. There's going to come a point where, the solution, the central bank action just won't be effective, whether they want to do it or not. We're seeing diminishing returns on that.
Yeah, exactly.
Go ahead.
The thing that worries me is that investors will not recognize that until far too late, and that's the big worry.
We're up to a break right now, so let me take the break, because I want to come back with Lance and talk specifically about, this is an incredible kind of world that we're asked to invest in. And I want to get his advice on the kind of approach that you personally should take and the kind of things that should be in your consideration. Lance Roberts is, he's done so many things. I love his work, but you can find him at realinvestmentadvice.com, realinvestmentadvice.com. I'll be back with Lance in just a couple of minutes right on the Money Talks Network. Usually do a hate mail of the week. Well, this one I've gone for the month. I was going to, coming up to this weekend, I thought, no, let's see which comment I made generated the most hate mail. I'll have that for you very shortly. Plus, we were talking about, hey, Canada Day weekend, what have Canadians invented that we should be so proud of? I mentioned the zipper. Come on, Gideon Sandbach, 1913, invented the zipper. Look around and see how important that one was. The big green garbage bag, another Canadian special. Harry Waslick, I think his name was. Well, I've got one that's going to top my list of Canadian inventions that I'll bet you don't know originated in this fine country of ours. Joining me on the line right now, I've got Lance Roberts. So pleased to have him with us in this environment of turmoil. And you look at the volatility, Lance, I mean, my goodness gracious, whatever direction. So, and I'm just, I look at individuals and we say, how should they even approach this? I mean, what can they do? It's not fun for them, that's for sure.
Right. Well, first of all, I wrote several weeks ago as we were heading up into this whole Brexit issue. Let me just restate something really quick, is that since May of last year, I've been at 50% exposure in stocks. So in other words, our portfolio is right now about 35% stocks, 35% bonds, the rest is cash. We've been that way since May of last year. So this volatility, we've gone up and down a whole lot over the last 13 months. Haven't gone anywhere in terms of the S&P 500 in the United States. So my recommendation has been, for the last several weeks, unfortunately, is don't do anything here, because whatever bet you may make will likely turn out to be wrong. And that's exactly what we saw with the volatility following the Brexit election. If you went short, you were wrong. If you were long, you were wrong. It just depended on where you were at the particular moment in time. So the big winner, though, has been fixed income.
Well, again, and do we see any environment where, talk about an old song, is that any time there's been talk of higher interest rates, and of course we got that famous statement out of the Federal Reserve last December saying expected 4 in the coming year. We've got 1. It seems every time we come up to another Federal Reserve moment, they say, well, not yet. And of course in Canada, I don't see any pressure whatsoever upwards on interest rates. Our economy loves to chug along at C- at best, with some very troubled areas. So I think fixed income, quality fixed income has been rewarding, and doesn't it look like rates are going lower now?
Well, it does, and this is the interesting thing about this rally since last Tuesday. During the decline in February and Friday and Monday, when stocks went down basically about 100 points, bonds rallied almost 20% in terms of price over the course of those two trading sessions. Had a huge rally in bond prices. Now, what you would have expected is when the market rebounded and went back up, that we should see money flow out of bonds back into equities. That didn't happen. The 10-year Treasury in the U.S. is still trading at the same level it was as if we were in the middle of the Brexit issue. So, in other words, there's not a lot of conviction that this rally in stocks is anything other than just central bank interventions at the moment. Investors aren't buying it, particularly those with large money. But but the key thing here is what interest rates tell you. You know, people talk about interest rates are going to rise and the Fed's going to do this. I wrote in December of last year, the Fed's going to do one interest rate hike. They're going to be done after that. The reason is that interest rates are a reflection of economic growth and inflation. You have neither anywhere in the world. You've got $10 trillion in assets globally trading at negative interest rates. You've got the 10-year Treasury trailing down towards 1% growth. That doesn't tell you or give you much confidence in economic quality, earnings quality, et cetera. And this is one we were saying earlier, is that despite central bank intervention, there is going to be a point to where the market fantasy of prices come back to meet the reality of economic underpinnings. That's just a function of time.
And, you know, and I'm watching a very big name, or I'll give you one, Alan Greenspan's little speech last week. You know, if I wasn't staying up at night, that one gave me the nightmare to do it. I mean, he said he's never been more pessimistic in 23 years of public service. And come on. Yeah, that wasn't cheerful.
No, it's not, but it's true. And if we take a look, and again, you know, I apologize, I'm not as, you know, in depth in the Canadian markets as I am in the U.S. markets. But for us, you know, for what I'm looking at here in the U.S., you know, we've got subprime debt running back up. We've got subprime auto debt at higher levels than we were in 2007. Corporate leverage is back to where we were prior to the last financial crisis. You know, no matter where you look in terms of margin debt, et cetera, you know, the risk has been rebuilt back into the markets, but yet you don't have any type of indication of sustainable organic, and organic being the key word, where consumers are driving the economy. Mm-hmm. There is no evidence that is occurring.
And I think that's a real key, is that people forget, yes, we've had a market dominated by central banks. There's been phenomenal manipulation of whether it's interest rates or whether, you know, with an eye to currency rates, whatever it's been. But the whole point was the central bank action was supposed to be the stopgap. It was supposed to be like a bridge financing till the economy got more productive and more output increased and things like that. Well, that hasn't been the case. And that's why I say, for example, in Europe, you're looking at a completely failed economic model of big bureaucracy, big regulation, and big taxation. That's what's not part of our conversation. I mean, one of the surest bets I've got is that economy cannot recover with that much government involved. And it's proven me right for 7 years.
Absolutely. Listen, I know we're about to run out of time here. I want to clarify one thing. So you were talking about your hate mail that you're getting. I get that every day.
You're saying I'm a piker on the hate mail front.
Right. Well, you know, on realinvestmentadvice.com, you know, what we write about is specifically how money and markets really work. You know, outside of this kind of nonsense that's put out by the mainstream media every day, we talk about how money actually works. And even though what you and I are talking about, we're immediately dominated as bears in our opinion. Yeah. We're pessimistic. We think the world's going to end. It's all going to be horrible. You know, as investors, understanding the long-term views, what you and I are talking about is extremely correct. We are not headed towards a good end of where we are in the markets. But in the short term, we do have to understand that price trends dominate fundamentals on short-term basis. As John Maynard Keynes once said, the market can remain irrational longer than you can remain solvent. And this is where we are. So, you know, there's a potential we may see a breakout of this market above 2,100 and see the markets potentially move higher. We've got a lot of work to do. The valuations don't support it. But don't be surprised if that doesn't happen because of what's happening with monetary policy. But the risk predominantly outweighs the reward because the downside potential is 20 to 30 to 40% in markets when it happens that we have this correction back to reality. But I do want people to understand that as investors, we do have to manage the short term of the market, but we also have to be very aware of the long term. So while you and I talk about kind of big macro events that are very bearish long term, the markets can prove us what seems to be wrong in the short term will eventually be right. But we have to manage money for both sides.
Well, my take is also is that money always has to end up somewhere. And so we get this immediate panic. It goes to the U.S. dollar, goes to the U.S. treasuries, go to German bonds, Swiss bonds. I think in the end, actually, there's going to be a major bull market, but it's not going to be economic based. It'll be financial based. It'll be where else can I put my money based,
Exactly.
And
well,
so
exactly.
it's fascinating times.
Yeah, it is. I mean, Tina, this whole thing about there is no alternative, the Tina investment. Dividend yielding stocks are every bit as much of a bubble as probably at any other point in history, because that's where all the money's hiding. And when the ultimate reversion occurs, the things that people think are the safest, dividend yielding stocks, staples, real estate investment trusts, these type of things, these are very likely going to be absolutely the worst places to hide. So, it's just as with all things, money migrates into areas of and pushes things to the point of irrationality, and eventually those things tend to turn out badly. So I don't disagree with you at all about where money is going to be made, and I think it's going to be in some places that people currently don't expect it to be made in the next couple of years.
Absolutely fascinating as usual, Lance. I so much appreciate you finding time for us, and also let me wish you a happy Independence Day.
Thank you so much. You too.